No one in the stock market can predict the prices of anything. Hi everyone, welcome to today's video. So on today's video, I'm going to discuss with you how you can make 15,000 rupees income on monthly basis by investing 10 lakh rupee in the stock market. A point to be noted here is that this is not regular income because the stock market keeps going up and down. So some years you will make a lot of return, some years you will not make a lot of return. But your average return can easily be 15% and I will mathematically prove it to you why. I will also explain why people do not make returns in the stock market. In fact, according to one of the statements by Mr. Nitin Kamath, and this is the statement, you can take a look at it. He said less than 1% traders actually beat FD returns. So FD returns are 5 to 6%. 99% of active traders are not even able to beat these returns. So this is a very worrying scenario. So therefore, I will discuss 5 specific points with you as to what 5 steps you need to take in order to ensure that you are making that 15% return. Press the like button. It will make me super happy. It would indicate to me that you like me making this type of content. So I would continue to shoot such videos. So before jumping into 5 specific steps, let me first and foremost mathematically prove it to you why making 15% returns in India is not that complicated. So the math of 15% goes something like this, that first and foremost, the GDP growth of India is roughly 8%. Now you can check a lot of statistics. Here is an article which displays that this year's forecasted growth of India's economy is roughly 8 to 8.5%. So this is the growth of the Indian GDP. Second key point that you need to know is that the inflation in India is roughly 6%. Why have I taken inflation? I will explain it to you in a minute. So if you add both these numbers, it comes out to be 14%. So let me first and foremost explain why this 14% including inflation attributes to growth. So essentially, what is GDP of a nation? GDP is the total value of goods and services that is produced in a particular economy. So there is a real part of GDP growth. For example, imagine that this year in 2022, there is only one Maruti car that is produced in India and it costs 3 lakh rupees. So what is the GDP of India? It will become 3 lakh rupees. But every year what happens is that inflation also rises. So assume next year also there is only one Maruti car that is produced, but inflation also goes up by 6 to 8% in India. So what is the total value of goods and services that is produced? It will become 3 lakh plus 6% of 3 lakh. So this will become roughly 3.18 lakh. So this becomes the total value of GDP of an economy. So the bottom line that I want to outline is that the growth in India is roughly 14%. This is the growth number for India. I would also argue that our stock market also approximately grows at the same rate. Why is that? Very simple to understand, because what is GDP made of? It is made up of businesses like Maruti that are producing a lot of Maruti cars, Tata Motors car, FMCG companies launching shampoos, whatnot, right? So essentially it's the total value of goods and services that is produced, and it gets represented by what? It gets represented because all the major companies are listed where? On Nifty 50. So if we take Nifty 50 as a good proxy, because it comprises of top 50 companies in India, and they also roughly grow at the same rate at which the entire growth of the nation is happening. And therefore, it has been seen that Nifty's average return, 2 decades average return, has been roughly 12.5%. So why am I telling you all this math? Very simple reason, because I want to outline the fact that if you are making less than 12.5% returns, then you really need to think about your stock market strategy and understand the 5 key points that I'm going to speak about next. Also, before starting these 5-point discussion, I would like to thank our sponsors, which is ET Money Genius. It is a wonderful product that helps you create personalized investment plans. It helps you figure out the right portfolio mix in terms of equity and other asset classes, and also gives you timely updates in terms of rebalancing your portfolio. It's a wonderful product, especially for retail investors who need customized help. So in case you are struggling in terms of making stock market returns, ET Money Genius might be a great product for you. So with that said, let us start the 5-point discussion. Point number 1, you need to understand that majority of the people who are investing in the market, they keep on focusing on the price of the stock. They never analyze the business, or they are not even focused on analyzing the business. Now, as a result, what happens is 2 things happen. Number 1, you are not able to predict the prices because no one can predict the prices, and I'll explain it to you why also in a minute. But second and more importantly, that whenever price drops for a great stock also, there is a lot of panic buying and panic selling that happens in the market, and as a result, people end up making insane amount of losses. So let me demonstrate via taking the examples of a future forward contract as to why stock market prices cannot be predicted for any stock. I'm giving you a very honest discussion. No one in the world can predict the stock price of any stock even for tomorrow. I will again explain you mathematically why. Please press the like button if you like this insight. So let's pick a futures and forward contract on steel. So let's imagine 2 companies. One is JSW Steel. It produces steel and it sells that steel to companies like Maruti, right? So let's assume this hypothetical example. So you have a seller of steel and you have a buyer of steel. What will Maruti do? By buying steel, it will manufacture cars. Now let's assume that JSW Steel is right now selling steel at 1000 rupee per kg and Maruti is buying steel at 1000 rupee per kg. So what is JSW scared of? It is scared of the fact that, you know what, if tomorrow the steel prices go down, if it becomes, let's say, 800 rupees, then my business will go down because I am selling this stuff at 1000 rupee. Now suddenly if the international steel prices go down, then what am I going to do? I will be making a lot of losses. So it might decide not to expand its capacity, build new factories, etc., etc. Similarly, if you take a look at Maruti, what will it be scared of? If this steel tomorrow becomes 1200 rupee per kg, then I will get scared because I'm buying steel. I have set all my operations, hired a lot of people, optimized my processes, and just because of the increase of steel prices, I might end up taking a lot of loss. So they might decide not to expand their business further. So in the market, what ends up happening is that there is a forward or future contract that is done. So both these parties enter into forward or future contract. What is the difference between forward and future? One is traded over the counter, one is not. That is the difference, but essentially it's the same thing. So forward and future contract is just a legal contract, so to say, where both the parties fix that, hey, we are going to sell steel at 1000 rupees per kg for the next 10 years and Maruti gets to buy steel at 1000 rupee kg for the next 10 years. So they do such a contract. And this is a hedging instrument. That is the reason why I also say that I trade in futures and options to hedge my portfolio, not to bet on stock prices. Stock price prediction, no one can do. Now, use your logic and understand. This company's entire business is based on what? It is steel. The name itself comes in steel. So their entire business depends on guessing the price of steel. And they are unable to do it. If they were able to do it, why would they go and sign this contract that, hey, we want to fix our prices because the prices can go up tomorrow. Why would you not want to benefit? Tomorrow, the price can go to 2000 rupee per kg, 3000 rupee per kg, 4000 rupee per kg. Then why is it that a company like JSW Steel, a $1 billion company whose entire business revolves around predicting the prices of the steel, is not able to take that bet? Same goes for Maruti. If Maruti is sure that, you know what, tomorrow steel prices are going to fall and they can correctly predict it, then why do they go and do these hedges? It doesn't make any sense, right? No one in the stock market can predict the prices of anything. But what is it that retail investors do? We do the complete opposite. We try to guess the stock prices, that tomorrow ITC will go to 250 because my MACD RSI tells me this. No, it cannot tell you that. Tell me this, that even the recent crisis, anyone could have predicted the extent of these crises? The answer is no. Everyone thought that, you know what, COVID is over. Now there is bull run in the market forever. Just 1.5 years into it, Russia-Ukraine crisis blew up quite a lot. Now there are inflationary concerns, bunch of other different things. You don't control Fed actions. You don't control what Shashikant Das is going to do in India. All that stuff. So the bottom line is that all these things have an impact on the stock market and we can't foresee these actions. But retail investors unfortunately keep playing around the stock prices. They do not focus on buying quality business. If, as retail investors, we focus on buying quality businesses that are making revenues, businesses that have good management, businesses that make profits, that have products that are good, people are buying those products, we will not make a loss. Yes, there can be temporary notional losses in companies like HUL, but people start panicking that, you know what, Akshat, HUL prices have fallen. I have gone bankrupt because I sold HUL at a 3% loss. Come on, guys, if you cannot even hold a company like HUL with a little bit of loss on your portfolio, what other company do you have faith on? Take a look at the HUL chart here. Tell me like a period of 5 years when it has not given returns. If you just take a look at 3-month or 4-month window and start panicking because some good company like HUL has fallen, then unfortunately stock market is not the place for you. So be honest with yourself and please think about it that there is no point in predicting the prices. As long as you are buying good businesses, you will make money. No one is going to stop you from making money. Now comes the second point, that we as investors do not have our own investment system. Now, what do I mean by investment system? For example, if you study the investment style of any major investor, be it Mr. Warren Buffett, be it Mr. Charlie Munger, be it Mr. Rakesh Jhunjhunwala, be it Elon Musk, they all have their own investment style. So let me first and foremost do a very quick commentary on Mr. Warren Buffett's investment style. And these bullet points encapsulates his entire investment strategy. So this highlighted part, if you quickly read through it, the top 5 investments in Buffett's holding company Berkshire Hathaway are Apple, Bank of America, Coca-Cola, American Express, Kraft Heinz. Out of 5, 4 of his companies are cash flow companies, except for Apple. All other 4 are cash flow companies. And Apple is the only tech stock that he holds. So Mr. Warren Buffett, at the peak of his career, started investing in cash flow based businesses. He has always been an advocate of companies like Gillette or Coca-Cola because they have a very predictable cash flow models. And essentially, he has stuck to that investment style and investment strategy. Apple is the only exception to his portfolio. And if you go back, read his commentary approximately a decade ago, he was not a big believer in the tech stocks also. But over time, he took one position in tech stock, which is technically Apple right now, and he has stuck to his core investment style. 4 out of 5 assets in his core portfolio are still cash flow based stocks. Why? Because he is a cash flow oriented investor. He understands his investment style and he sticks to it. He plays by it. He follows it and he does not give up on that investment style. On the flip side, if you go and analyze Elon Musk's investment style, you will see that he has invested in something like DeepMind Technologies. Now, what is DeepMind Technology? It is an artificial intelligence firm which got acquired by Google, and Elon Musk made insane amount of money. What type of businesses does Elon Musk run and where is his money tied into? So he runs Tesla, which is technically a tech company, boring company. Again, it's a revolutionary tech company, so to say. Yes, it is doing infrastructure development work, but it requires a lot of tech in order to do that. What would you categorize as SpaceX, which is one of the companies that he run? Again, you have to think about it tech, right? Why? Because SpaceX is able to launch a space vehicle at almost 1/5 the cost of what Boeing can do, which is one of the largest manufacturing firms in the world. Why? Because SpaceX technically again is a tech firm. So the point that I'm trying to make is that Mr. Warren Buffett sticks to cash flow based company. That is his investing style. Mr. Elon Musk sticks to tech oriented investments, which is his investment style. He comes, disrupts traditional conventional industries by using more and more tech because he understands that game. Similarly, you and I as an investor should understand our strengths and limitations. So how does this apply to us? Let me give very quick commentary on it. So for example, majority of us are working somewhere. We would have a 9 to 5 job, or probably we might be working 10 hours a day. Now, do you really think that we can keep up with the stock market? Will we be able to trade, do intraday trades, keep on monitoring our systems, keep on checking Nifty 50, all that stuff? We can't do it majority of the times. Even I'm involved in building my own companies, writing my book, advising startups, etc. So we don't have that luxury of time to keep sitting in front of our screens. But what we try to do, many of the retail investors, should I become a trader? Should I become a day trader? Should I leave my college? Should I leave my job? Do this full time? Please don't do that. Please understand your own limitations. That is the very important point. Please try to discover your investment style. You can easily do this by taking positions and starting your investment journey about the industries where you have little bit of expertise. For example, if you are working in tech, make a decision whether to buy tech stocks or not. If you see some very good opportunity, take investments in it. Similarly, if you are working with, let's say, FMCG companies, it will be very easy for you to understand what is happening in that space, read more about it, and then take positions. Educate yourself about the industry where you're already working full time. It will be easy to start crafting your portfolio from there. Let's move on to point number 3. So the third reason why our portfolio does not grow by 15% a year is very simple, that we actually are in the habit of profit booking. There is a very interesting story about Mr. Peter Lynch. So people who do not know who Mr. Peter Lynch is, here's a short summary about him. He ran Fidelity Magellan Fund and grew the portfolio from 100 million to $13 billion. Crazy returns. One of the highest return generators of that decade. So he wrote a book called as One Up on Wall Street, and he gave a quote which was even used by Mr. Warren Buffett. So the quote goes something like this, that selling your winners and keeping your losers is like cutting the flowers and watering the weed. So for example, if we buy a stock at 100 rupees, it goes to 150, then we sell it, we book a 50 rupee profit, right? And we have sold that stock completely. So we should not be doing it, especially if it is a very good business. Why? Because what is going to happen? That you have made this 50 rupee, what are you going to do with it? You have gotten into a lut in terms of making quick returns. So what are you going to do with that 50 rupee? Guess what? You are going to pick the next stock and look for the next multi-bagger or penny stock or a horrible stock. And you are going to invest your winning in that stock. And 9 out of 10 times you are going to lose that 50 rupee profit also. So what ended up happening in this entire game is you got out of a good stock, you planted that profit into a bad stock and lost everything. So you are away from a good stock also now. So the point that I'm trying to tell you is that unless you learn business analysis, you will not be able to succeed in the stock market. You will not be able to develop your own system, and you will always go for the thrill in the stock market, not from an investment point of view. Now you will ask me that, Akshat, then how do we book profits? So there are much more sensible ways of booking profits. This video will become really long. I'll make a separate video on profit booking if there is enough interest for that video. So let me know in the comment box. I will definitely curate a video. Now comes fourth point, why retail investors do not make 15% return in the market. The reason is that we are very egoistic. Now, what do I mean by egoistic? So let's understand this by picking an example. So let's say that you bought a stock at 100 rupees. It fell to 80 rupees. Then what are you going to do? You are most likely going to average it. Then it falls down to 60 rupees. What are you going to do? You are going to average it even more. So you are downward averaging it. Now the problem happens that if that stock is bad, now you have purchased so much of it and you're sitting on so much loss that it might give you a headache. Why did you downward average a bad stock? Because you were egoistic that I cannot see a loss on any particular equity. Even the biggest of the biggest investors, when they have 20 stocks in their portfolio, at least 7 or 8 of them will be in red. So you don't need to get scared by seeing stocks in red, and please do not keep on downward averaging bad stocks. This is the first way in which the ego plays out. Ego also plays out from a portfolio perspective. Now you know for a fact that Nifty 50 is going to give you 12.5% return without doing any magic. And Nifty 50 is one of the best passive indices where the expense ratio is very less, commissions are very less, all good things. But we end up purchasing 20 mutual funds, and year after year, the mutual funds are not giving us any return. They are not even giving us 10% return. But we keep on holding those mutual funds. Why? Because we cannot afford to see loss. If you cannot afford to see loss and you do not know how to book a loss, you are not being rational. It's very important to be rational in the stock market. If you get a sense that, hey, you know what, I just don't have the time to study the stock market, I'm not interested in it, but I want to invest, please go and invest in passive mutual funds. You are done. You don't need to do any magic there. If your mutual fund portfolio is not even giving you 12.5% return, please go and invest in passive mutual funds. If you are picking individual stocks and if you don't have the ability to make returns from the stock market, please go and invest in passive mutual funds. It is as simple as that. So all these basic things can be tried out. Yes, I completely agree that when you are good in terms of investing in individual stocks, if you have the time, if you have the capacity to learn, I highly encourage you to do that, because then you can make like really crazy returns up to around 20-25% also. But you need to do an independent analysis whether or not you are ready to invest time and effort in terms of learning that skill. If you have no interest in it, please don't simply trade on stock recommendations. Now comes fifth and final point, that you need to update your investment system periodically. What do I mean by that? So understand it conceptually, that what is stock market? Stock market is a collection of businesses. Now the nature of businesses change quite aggressively almost every single decade now. Can I prove it? Yes. Take a look at the story of FANG stocks, the top 5 American tech stocks. You will see that couple of decades ago, just 20 years ago, these FANG stocks did not even have 5% representation in S&P 500. Now, the top 5 stock makes up 25% of S&P 500. So, the nature of businesses itself has changed. So unless you are aware of that, unless you are willing to study a little bit about tech, you would have invested in age-old businesses only and you would have taken a lot of losses. Who studied it? Mr. Warren Buffett. He understood that, you know what, tech, I'm not good at it, but yes, I have to take some positions in Apple. It was against his investment system, but he still understood the point that this is where the world is moving. He changed his opinion, updated his belief system, learned more about it, and took a large chunk of his investment in Apple. So it's very important to update this. Same is the scenario playing out in India. For example, take a look at funding of startups 10 years ago. There was so much heat against entrepreneurship. It's not as if entrepreneurs were worshipped, so to say. Right now, the dynamics are that entrepreneurs are looked with reverence. There is so much money that is coming into the startup ecosystem. So many fintech, edtech companies are getting built. What is going to happen 10 years from now in India? A lot of changes are going to happen. You need to study those changes as an investor. If you're not willing to sit and study where the world is going, you will never become a good investor. So I say, again, I will get a lot of heat that, hey, if you don't like cryptos, it's okay not to invest in it, but at least learn about it. There are good parts about cryptos. For example, blockchain is there, DeFi is there, metaverses are there. You must understand it. Just because, hey, you know what, someone said that crypto is tulip, I'm not even going to study it. That way, you will not be able to update your knowledge ever. And if you don't update your knowledge ever, you will never, ever become a good investor. A related final point here is that if you take a look at any investor, the investors who make crazy amount of money, they identify trends early and they invest in those trends early. Take a look at Mr. Rakesh Jhunjhunwala's investment in Titan. He invested in that stock 1.5-2 decades ago, roughly. He did not sell that stock. He stayed put. He has added more technology companies in his portfolio now. So all the points that I'm telling you that, hey, don't cut your flowers and water the weeds. Update your investment system. Buy good assets. Identify trends early. Stay invested. All these are being exhibited by Mr. Rakesh Jhunjhunwala also, Mr. Warren Buffett also, and all the other major investors that you will see. So in summary, it is very important to understand a few key points. Number one, it is absolutely possible to make 15% return in the stock market easily. provided that you are buying good businesses and not making the mistakes that I talked about. So check the links in the description box also. I will link some of the reference material for you to read. Also check ET Money Genius product. It's a wonderful product. And if you want to create a personalized investment plan, ET Money Genius can help you out. Thank you so much, and I will see you tomorrow.